Good morning and welcome to today's webcast, Goodwill Impairment at Financial Institutions. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
With that, I will turn it over to Gabe Nachand, Partner and National Practice Leader for Financial Institutions at Moss Adams. Gabe?
Thank you, Amy. This is Gabe Nachand, Partner, Financial Institutions National Practice Leader, and I'm pleased to present my co-presenter, David Gisen, Senior Managing Director, not just Managing Director, Senior Managing Director with Ankura, a global consulting firm that specializes in valuation across a multitude of industries, but has a strong emphasis in the financial institution space. And for these types of presentations, we really like to bring the perspective of different firms to the audience, and I think you'll find some value in that. And especially in a sense, with this case, we're getting the band back together, so to speak, because it was a little over a decade ago that Dave and I went back and forth on a number of Goodwill impairments that involved Step 2 evaluations, which has been removed from the process. So I think we can provide some good insight on how we see things differing back then versus today. So with that, we are actually going to start with the polling question. I'll kick it back to Amy.
Okay, our first polling question is, do you have goodwill and how much? A, yes, and greater than 2% of total assets. B, yes, and less than 2% of total assets. C, no. And last one, D, I'm here for the CPE. And we'll give everyone a couple minutes to respond. To participate, please click the button next to the answer you choose and hit submit. We'll leave it open for a few more seconds. Okay, here are the results.
All right, so in excess of, or less than 2%, I think, there's no bright line in any of this, but I would say, when we talk about some of the current cases, in excess of 2%, obviously more you have, the greater risk you have. And good to see we've got a lot of folks here for the CPE, but I'm sure you're going to enjoy it just as much. Go ahead and kick it over to you, Dave, to get us kicked off.
Okay, well, thank you, Gabe, and good afternoon. Or good afternoon to those of you in the Midwest and the East, and to those of you in the West, good morning. And as Gabe said, I'm Dave Gisen. I'm a Senior Managing Director at Ankura, and being senior, Gabe, all it means is I'm old, and I've seen it before. So we look at this, and I guess the first question is, why is everybody here? We went through Goodwill Impairment 2008 to 2012. We saw a lot of people in the audience probably did it the last time, thought, oh, Lord, I hope we never have to do this again. Well, unfortunately, we've reached a point because of COVID, because of the changes in the bank stock market, where this is becoming a real issue. Okay? From 2017 to 2019, bank price to book ratios were comfortably above 100%. Okay, nobody worried about this. In accordance with ASC 350, everybody that we worked with did a qualitative assessment. They looked at a number of things and they basically said, we're not impaired. Their auditors, by and large, looked at it and said, hey, that's fine. Don't see a reason. If you're trading at 110 on book, for example, the probability that you're impaired is pretty light. You can see by the chart on the top right-hand side, we've gone from a median price to book statistic of right at book is gone from over right at or right above book to when we put this together and at the end of August, early September, what we saw was the industry was trading at about 70% of book. And smaller institutions, which for this analysis, we looked at it and said it's under $2 billion in assets, have dropped from just a teensy-weensy little bit below book value to about 69.9% of book. Under those circumstances, the question is, I may well have a triggering event, which means I'm impaired, okay? So you think, all right, and what we found was with a lot of our clients, the audit, for 331, the auditors took the position that, hey, we don't know whether this is a long-term or short-term event, so let's give people a pass or go ahead and do a qualitative for the quarter. At 6:30, we saw this, and we saw it with, we started to see a lot more of people doing a serious qualitative assessment. And so we move on. Since that time, though, the market has started really to come back. And again, we're looking at early September when we started putting this together, but you could see that the market was trading above kind of where it was a year ago. The bank stock market is still hovering around 20% below where it was a year ago. And as a consequence, people are being asked, do you do a quantitative assessment? So we thought, okay, what happens? What's the worst thing that can happen? Well, we all know that the worst thing that could happen is you have to charge off your goodwill. There's some folks that did it. Umpqua in Portland is a big one that did. They wrote off $1.5 million of goodwill. PacWest down in the Los Angeles basin wrote off $1.3 billion. CIT, BBVA, even Little County Bancorp in Wisconsin wrote off $5 million of goodwill in the first quarter. Opus did it, and part of that probably was the result of their M&A transaction with Pacific Premier. The good news out of it, and by the way, we're probably looking at least a reasonable possibility that we're going to see a lot more of this before year end. We kind of view it, we know we've got one right now that's touch and go that we're working on as to whether it's going to be or not. We've got a couple of others that I think we're going to have to work really hard on to make sure that we understand where the projections came from. The good news is that at least for Umpqua and PacWest, they've outperformed the market. Not by a lot, but they've tended to outperform it, which means that the impairment by itself in terms of their equity value didn't have a really great implication for it. As one of the CFOs that we talk to, that we work with, has said to us about the impairment, the market has already baked the goodwill impairment into our stock price. The bad news about it, and I think there's two issues that we see that most of you are going to have to face if you end up facing goodwill impairment, is first of all, what does it say about your acquisitions? Do you run the risk that people are going to have some kind of negative view of what you've done with acquisitions in the past, and your board perhaps might get a little gun shy about a future opportunity that may be very, very good to consider. Second issue is if you are publicly held, if you've got activist investors in your shareholder base, is it signaling something to your activist shareholders that create some issues with regard to their concern about the continuing operation of your institution? So the bottom line is there is both good and bad in here. The good news is ultimately it's obviously not going to count against your capital either. And you're right, it's not going to be a cash flow event. But the bad news is, you just don't know how the community, how your constituents are going to react to this. So with that, Amy, can we go to the next polling question?
Yes, so our second polling question is, what is your current sentiment on goodwill impairment? A, the accounting standards didn't contemplate a global pandemic. This isn't fair. B, the new accounting standards seem to take judgment out of the process and get to a measurement of impairment faster. It is what it is. C, I can foresee impairment on the horizon, but I don't agree with it. D, can I just write it off and be done with this? Or E, I'm here for the CPE. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And I will leave this up here for a few more seconds to get some more responses. Okay, here are the results.
Very interesting. I'm not sure I had any preconceived thoughts on this one, but I think B's a very accurate statement. And I think as we talk through this, you'll see that more and more here.
Hey, Gabe.
So, yes.
Real quickly, I think if we go back to just the survey answer, that D answer, can I just write it off and be done with this? There's more of that out there than I was surprised a little bit. I've seen a little bit more of that in talking to our clients than I thought I would see. But the rest of this is kind of predictable in terms of what we've heard. But that D answer was interesting, to put it mildly. We have heard it, and people are just saying, good, I'll just get rid of it.
Yeah, no, I think if you could take the sentiment out, you mentioned in terms of how the market reacts, I mean, how is your community going to react when you post a $50 million loss for the quarter, $100 million loss for the quarter? Granted, again, it's non-cash, doesn't affect your regulatory capital, but how are your customers going to react to that? If you could take all that off the table, I think D could probably be half of the people, at least maybe more. So before we get to kind of what I consider the more interesting part on the valuation side of things, and really talking about qualitative assessment versus quantitative, I wanted to go through the accounting and kind of how we got to where we got here a little bit. So the accounting standard update came out in 2017. Now, just to clarify a little bit, it's effective now for calendar year-end SEC filers. It's periods beginning after 12/15/2019. So there are a few non-calendar, a few fiscal year ends out there, and then there's dates for other folks out there with the credit unions being the last date. Early adoption is permitted, but it must be done on a prospective basis. I would say this standard probably, when I think back with the various financial statements I read and the institutions I work with, there's a lot of people that early adopted this because it looked like, oh, it's easier, it's going to save time and money, don't have to deal with it much anyway. Really seems like it puts a little more emphasis on the qualitative. I don't have issues with qualitative, and so they early adopted. And so, in a way, maybe now that maybe you wish you didn't, but we'll see how that lands and plays out. And then also another consideration would be, emerging growth companies as well, which get from an SEC perspective. Although I did see a lot of them early adopt this as well. So the nuance change here with this standard versus what was done previously is, it changed the concept of impairment from when the carrying amount of goodwill exceeds the implied fair value to impairment existing when the carrying amount of the reporting unit exceeds its fair value. And so that implied fair value, that was very much that step 2 process where you went through the theoretical acquisition process, which you could get pretty creative in there. And I'm sure Dave would love to comment on the step 2 as we get a little further in here. But that option has been removed under this latest accounting standard update. And a good reminder that you always have the unconditional option to skip over the qualitative assessment, go directly to the quantitative, and you can switch back the next quarter and you can bounce around and you can do as you please there. Personally, right now, I don't see anybody immediately skipping the qualitative. Although I suppose you could if you know you're in that situation. So, I think consensus definitely is this new standard reduces the cost and complexity. I think that's definitely something that is pretty clear out there, but that has some consequences, and I'll get to those. So to summarize in one chart, the goodwill impairment and the changes, this is a melding of the old standard and the new standard. Originally it was kind of a step 1, step 2, and then they introduced a step 0 with the qualitative, and that's how most of us last time we dealt with impairment, prior to this year. You kind of work through that step 0, step 1, and then you get to step 2 and do the hypothetical or theoretical acquisition. Now, it's basically the step 0 and the step 1 stay, but technically speaking, the terminology is qualitative assessment and then a quantitative assessment. Although you will still see, I still see quite frequently the step 0, step 1 being said. Hopefully you're not hearing, if you've adopted the standard, hopefully you're not hearing the step 2, because that's was kind of the secondary quantitative test that doesn't exist anymore. So now today, under the new standard, it's qualitative and quantitative. If you're under the old standard, it's still step 0, step 1. So goodwill impairment indicators, these are just actually directly out of the standard, straight out of the text, and it's good to bring these things up because these are not only, if you go to the standard, this is what's in the qualitative section of a qualitative analysis. Now, these are also the factors that you evaluate in terms of, do you have a potential impairment event to then do a qualitative analysis. So there's a lot of confusion out there, and it's kind of like, well, how do I know I have a trigger event, or don't I just go ahead and do a qualitative analysis and figure it out? A triggering event, I'm already far down the path in terms of doing that qualitative analysis. Does that mean I did one? A lot of confusion there, but these are the factors that you evaluate for qualitative. They are the factors you consider in terms of a triggering event. And triggering event meaning, again, I'll back up a slide here. The standard requires a measurement for impairment annually. Most often we see those as November 30th or October 31st for calendar year ends, just so you have time to get through the process. And sometimes 12/31, but it's an annual test, and then it's required to be done more frequently if you have an impairment indicator. And so these factors kind of serve dual purposes in terms of indicators of triggering event, and then they're also the factors that you can use in a qualitative assessment. But it's not all encompassing. There's other things that you can consider for sure, and they're not equally weighted. The things that affect fair value the most should have more weighting, and so 10 factors doesn't mean 10%. per. You look at the factors, and you should be looking at positives and negatives. And so here's the first page of factors. Second page, and again, out of the text, I wanted to talk a little bit about the sustained decrease in share price. And some of you don't have a share price, but some of you index to other companies that do. But that sustained terminology it's not a defined time period. And I would say internally and talking to other peer firms and stuff, prior to the pandemic, I would say sustained, generally speaking, was considered around 90 days. It kind of lined up with the guidance, interagency guidance out there in terms of deferrals and modifications to loans. And there was no official rule, but people basically said, it's probably not a TDR if the deferral period is less than 90 days. There's other aspects of TDRs, but we kind of had that 90-day number. And then the regulators came out and said, we're thinking 6 months. Now, 6 months is kind of a bright line for them on that side. On the Goodwill Impairment side, you kind of have to look at it and go, well, we thought it was 90 over there. And we always, as accountants, you always like to analogize to different things. Now, that's pretty clearly 6 months from a regulatory perspective that the FASB did bless. So you kind of go, well, okay, maybe 6 months is a little more appropriate there. So sustained is not defined, but I would say certainly I don't think anybody would disagree on the accounting side that, if your stock prices decline for, say, a year, that's more than sustained. I feel like the 6 months is probably where most people are landing, and so I think we're getting to that point. So that's what's causing some additional challenges with what's going on out there as well. So some thoughts, some food for thoughts here. I know, Dave, you'll probably have a few comments on at least a few of these, if not all of them, but someone will leave for more of the valuation side of the presentation. But first bullet, adjustments to other assets should be reflected in carrying amounts before the Goodwill Impairment test. And we get a lot of questions in terms of core deposit intangibles. And if it's looking like you feel like you might have a Goodwill Impairment, is my CDI impaired? And if it were, that should be measured before you do the Goodwill Impairment test. If you've got other investments and things that are impaired, that should be done before the Goodwill Impairment test. And I would say in practice, at least as of today, things keep changing. We're not really seeing CDI impairment, and I'll maybe let Dave comment on that at the end of this slide here. And I know he's going to want to comment on the last bullet too. Things are changing frequently, and so whatever you did for first quarter, just to roll that forward for third quarter, second quarter, third quarter, may be appropriate for some, but I think you need to step back and reevaluate all considerations as you move through. And it is the reporting unit. If you have different reporting units, which is a measure below the segment level, that's where this should be done at. So in some of these impairments that have happened to date, there was some goodwill allocated to different reporting units, so they didn't write everything off. They wrote off most of it, related to, maybe the banking or the various banking segments, but say a trust or a broker deal or something like that, that wasn't written off. A lot of these other things I've mentioned already before. The last bullet, this is very nuanced and almost a dangerous comment here. Under the old step 2, there was, and got to pick my words wisely here, but there was a lot of flexibility in terms of where the impairment could lie. If you're looking at potential goodwill impairment, it's either in the goodwill or it's in some other assets. And so usually, the last recession, there was quite a few credit discounts in the loans, and so you'd have your purchase consideration side of the equation, yet you could demonstrate that the loan portfolio had credit deterioration that would, for lack of better terms, absorb some of that goodwill impairment. And so that was something that we saw quite frequently. And then this is very nuanced as well, but I would see, a lot of people, within that step 2 valuation process, they would look at building values and stuff. And now raising building values alone on the asset side, that would actually increase your potential for impairment. Yet we would see adjustments to the purchase consideration and arguments made in terms of, well, all the metrics are for institutions' operations, and we've been around a long time and we've got all this valuable real estate and stuff. Probably not a huge issue today, but really what I wanted to just demonstrate with this comment is step 2 had a lot of flexibility, so to speak. Dave, thoughts on these things?
Couple of things. Gabe, I think you're right about step 2. And what we found more than anything else, if you think of it as kind of like a fulcrum, you've got to keep it level or balanced, if you will. And when the value of equity decreased, to Gabe's point, what we found more often than not was that there was a significant decrease in the quality of the loans that were on the balance sheet of the bank, and consequently it was the loans that absorbed the losses or the reduction in value that came from the equity side. So that was the big thing, and in fact it got to the point with us, we had a bank that we were doing a step 2 for in Puerto Rico, and this was at a time when you had both the financial crisis as well as Puerto Rico's unique economic circumstances going on, and even they weren't impaired. And that led, I think part of the reason that FASB reacted the way they did to all of this with goodwill impairment was twofold. Number one, it was expensive. I'll acknowledge as a provider, we loved it. But the reality was for our clients, it was expensive to do that and very time consuming because of the data requirements and the efforts that we had to do to get a fair value balance sheet to understand where the impairment was. Second issue was very simply, there was nobody who was impaired unless you were in danger of being acquired by the FDIC or being taken over by the FDIC. Otherwise, almost none of our clients were impaired. And we weren't unique in that regard. Most of the industry, when you look across it in the last environment, there were very, very few impairments of financial institutions that were not ultimately either bankrupt for non-federally insured institutions, or alternatively, they were their NCUA or FDIC acquired. One other point, Gabe, to go back real quickly, you addressed the question of how long that you're into a significantly decreased stock price. And two things I would stress are, number one is it has to, if your stock goes down a few points, that may or may not be significant in terms of potential impairment. But when it starts to fall below book value, you've got an issue. Secondly, that with a lot of the people that we worked with at 331, as I kind of talked about in the beginning, most of our clients said, okay, we're going to let this one go. The argument being, who knows how long this is going to last? But at 630, we started seeing a lot more qualitative assessments than we had ever seen before. And the interesting challenge now at 930, we're down to a point where a lot of banks are going to have to look at impairment, and they're going back to their auditors and asking, can we wait till we get to that annual test at either 1031 or 1130? And we're seeing at least some consideration of that issue. And Gabe, let me ask you something. From your standpoint, if you've got a situation where a bank is trading significantly below book value at tomorrow, and their test date is 1031, how do you treat that?
Oh, hand me the easy question. I mean, obviously, case by case, but I think it is a challenge. If you let's say you're public and you do your 930 assessment and it's qualitative and you got to a point of no impairment and then, file that and then you're doing your annual impairment test as of 1031 and you come up impaired, I think that's a potential issue because, what's changed between 930 and 1031 in that, month? And so demonstrating that the impairment wasn't as of 9/30, I would suppose there probably would be some pretty extensive arguments in terms of the sustained period, if that's where you're at. But that's just one little piece of things. That's not the whole deal there. And so that would be a challenge. I mean, I would think your annual impairment test, the closer you are to quarter end, and you do show impairment, to me, that's a challenge. No matter when, if you have impairment for the annual test, I think the prudent thing to do is in any firm that deals with this should be challenging you as to whether the impairment was as of an earlier date. I think that's a fair and reasonable question. Now, lots of things going on here for sure, so very, very complicated. But we got a question on the CDI and in terms of valuing that, and I know you value it with undiscounted cash flow. So could you give me kind of your quick 30 seconds on why you aren't seeing a lot of CDI impairment right now?
Gabe, you kind of hit it right on the head. It's undiscounted cash flows. We have had, in the time I've been doing this, and that goes back almost 20 years, we have had exactly no CDI impairments among our clients. We got close on one in about 2007, 2008 timeframe because of a rate shift between the target and the acquirer. And after the acquirer overlaid the rates, they lost about 65% of the deposits that were in the target bank. So we had to do the test. But because it's on an undiscounted cash flow basis, as long as you've got enough positive benefit, if you will, for the core deposit intangible compared to the alternative funds of cost in the out years as you project a shift in the alt funds curve, you're not likely to be impaired. And I would stress this. We have a couple of clients that do this every year, and they have for a couple of decades now. And I would say that this is probably the year, if you haven't tested it or if you've sniffed at it, to be thinking about it, because I don't think very many people in this audience are likely to be impaired on their CDIs. But I think there's going to be a lot more questions and a lot more detail asked about it than in past years. So with that, Gabe, Amy, we've got a polling question, I guess, coming up.
All right, thank you. So the third polling question is, what is your stock price relative to book value? A, my stock price is 95% or greater as a percentage of book value. B, 75 to 95% of book value. C, 60 to 74% of book value. D, less than 60%. Or E, all others. And for those of you that would like a copy of today's slides, you can download them from the folder that says Slide and Deck Handout to the right of the slide view. And we will give everyone a few more seconds to respond. Okay, here are the results.
All right. Not a lot of quoted prices out there, which I think when we talk about, I think Dave will get into that a little bit in terms of it's probably a little bit of an advantage, I would say, in terms of the situation here. But I guess it depends on the perspective, I suppose. And we've got a number of questions here that we'll try to work into the presentation as well. So we see them. Go ahead, Dave.
So, okay, first of all, for those of you who are at 95% of Goodwill, or 95% of book value, boy, I'm impressed. I mean, your stock has really held up. You're doing something incredibly right. And my only comment is, wow. Okay, so with that said, we start with qualitative assessment. Gabe kind of outlined the issues that I think you have to look through to kind of make judgment on to determine whether you had a triggering event. Okay, we look at some considerations, and if you look over to the right, we kind of have, for those of you who have a publicly traded price, or those of you who are indexing yourselves against publicly traded institutions, the way we kind of look at it is this. If you're above 95%, you're not likely to have any kind of impairment. And for that 10% or 11% of you that were trading at 95% a book, if you've got a liquid and active traded market, guess what? It is extremely unlikely you're going to have goodwill impairment. You may have to do a qualitative assessment, in part to keep the auditors happy, and in part to just address some of the factors that you're in. So if they ask you if you have a triggering event, you've got an answer to it, okay? The second one that I look at is I bracket it between about 80% and 95%. It's questionable at that point whether you're going to have impairment or not. But a qualitative assessment is probable for banks in this range, and for some of you, particularly where you look at your internal, your confidential financial numbers, you look at things you haven't shared with the public, and you believe that there is a significant decrease in earnings coming, you may want to do a quantitative just to simply to check to make sure where you're at. The issue here, you'd start with the qualitative, you look at that, and if there are factors that are telling you that you're not, then lay it out, document them, explain why it is. One of the reasons is that one of the reasons why in this range, particularly the closer you get to 90+%, impairment is somewhat unlikely is because we're looking at things on an exit value. In other words, if you were to sell your bank, hypothetically, what is the implied value of your bank at a point in time when we measure impairment? So that's why we use things like control premiums. We use cost savings when we do the discounted cash flow analyses. We do those things all for one reason, to demonstrate that, hey, guess what? This is what the exit price requirements under ASC 820 are, okay? So we look at those. But what's really important here is to document whatever research you do. The documentation function is critical because my friend on this call, Gabe, and his colleagues are going to be asking you, how did you come up with it? Explain to me how the market participant rule factors into your judgment. Show me the indicators, show me the research, show me the emphasis that you did. If a bank is trading below 80%, okay, you've got a different issue altogether. Impairment is very possible. It's most likely you're going to be pushing toward a quantitative analysis in order to demonstrate where you are and whether or not you're having impairment. It doesn't imply necessarily, for a couple of reasons we'll be talking about, that you are likely to have impairment, but it's meaning that the burden of proof, if you will, is higher on you because of where you're trading. Okay, there are some things here real quickly I just want to go through, and we're going to touch on them a little further in a moment or two. But when we look at this, we look at the first question, do you have a triggering event? And the easiest way to look at that is to just simply say, where's the earnings performance? Where have they been? And particularly if you're not publicly traded or if you're a credit union. I would be really interested in knowing how you're performing against past years, against past periods, things like where your non-performing assets are, where your deferrals, skip pays are, where they might be, what's the impact of falling interest rates, and kind of straightforward, what's the impact of a bank's core markets? Give you an example. If you're in Florida or if you're in Hawaii, to cite two big-time tourism markets where a lot of the economy is based on tourism. In Hawaii in particular, it won't be until the middle of October that the 14-day required quarantine will be up, okay? In the state of Florida, there's still some concern over how many people can go into a place like Disney, whether the tourist attractions that make Florida, well, how do we put it, Florida, are still going to be able to be open, and what the implications are on the support businesses that support the tourism business. It's one example, but it's a real one that if your credit union, your bank has hospitality loans, it has resorts, it has travel factors, for example, Retail's another big one. If you've got a lot of retail projects on deferral, that's an issue. Okay. The other question is you've got to look at where the M&A market is as of late, and you've got to start to look at the issues of where we've been. Okay. There is a meld here.
Hey, Dave.
Yeah.
Dave, I'm going to go back a slide here and just want to highlight one thing and interject a question or two. And so, first thing, this chart to the right, this is not an official chart of anything. This is kind of what Dave and I agreed that we could agree on for presentation purposes. I mean, I was probably a little lower on the low end. He was probably a little higher on the high end. And so I'm positive there are firms out there that will think this is too conservative, even within people within the same firm. I'm sure somebody within our firm here might vary off of this a little bit as well. So this is not a perfect exact science. I think it moves. I would have been much lower earlier in the year as things progress on. The opinions change a little bit. So don't take this as this is not from the standard or anything like that. This is our collective kind of just guidelines. We've got a question.
Yeah.
And it has to do, and I'll try to answer this one. How can you say that impairment existed previously if you determined that at the point it was not a sustained decrease in share price? And I think I made an earlier comment in terms of looking back, and if you have impairment as of an annual test, and you previously determined that you didn't have impairment, how would you go back? The part that makes me nervous with the new standard is, there's a paragraph on the qualitative side and assessment of this that does not, in you having mitigating factors and positive evidence of not having impairment, that does not create a rebuttal presumption in terms of doing the quantitative test. So my concern would be you do a quantitative test later in the year and you determine you have impairment. Well, you may have, you maybe didn't go far enough earlier in the year. And I think that's the thing you got to look at. Now, personally, I think when you look at the sustained period, and if we're going to say unofficially that's 6 months, and it's probably close enough to third quarter, I think it'd probably be a little hard to pull back into third quarter. But I think it has to be looked at and it has to be evaluated. There's another question. I'm going to give this one to you, Dave. How do you think about and weight? How do you think about and weight the general disfavor of share value in the banking industry and similar deterioration in peer price multiples within the qualitative assessment? And I like this question in terms of the lines between qualitative and quantitative get blurred quite a bit when you build your qualitative assessment, because it's hard not to come up with good support that isn't quantitative. But what do you think about that?
Okay, the way I would handle it, and this is me talking, and again, kind of the same as the impairment chart considerations, there's differences of opinion on this stuff. I know how I would do it. And if one of our clients came to me and said, I'm trading at 75, am I impaired? What can I do? Okay, the first thing I would do is simply say, okay, let's take a look at what an exit multiple would be for your institution or an institution like yours, okay? And essentially, I need 25 percentage points, okay, or about a third run up in value. If I can demonstrate that, then from a qualitative standpoint, I'm probably in pretty good shape. And so I'm less concerned about that. How much weight do I put on it? Well, I think it's not necessarily a weight on a qualitative. It's just an indicator. And you've got to be able to demonstrate, frankly, that there are other factors that suggest that the market is either undervaluing your stock because there are material non-public facts that would change things if it happened. And secondly, I would be looking at what is the control implications on that. And that's why, I go back to this chart. Gabe, I think you raise a good point. This is why these are considerations. But if I'm in that 80 to 95% bucket, chances are there's enough of a control premium if you're a good quality institution that you're probably not going to be impaired. Probably not. You never say never, because the first time I say never, I will promise you something. I'll be wrong. Something will pop up.
Okay, Dave,
does
one more
that
question.
kind of answer? Okay.
Yeah, I think that's good. One more question before we move to the next slide. I've kind of thrown out this 6 months, and I'm analogizing to some of the other guidance out there in terms of COVID-related things, because these are fairly unprecedented times. I think we've always got to keep that in perspective. But from a person doing the valuations perspective, I mean, how are you thinking about sustained, and what is that period to you? Is it 3 months, 6 months, year? I mean, I know there's lots of things to think about, but not to put you on the spot too much, but how do you define sustained?
Well, since I've already put you on it once, that's fair, but okay. Gabe, I would define sustained as probably starting at 3 months, and I would be looking at trend analysis. But I think there's something else in trying to get it clear in that conversation with the people that help you with goodwill impairment or with your auditors is, what are you projecting for your earnings? Let's go back to March 31. And one of the big reasons that people were taking impairment at March 31 is there was concern in the month of March about compression, or about interest rate decreases and spread compression, and the implication that that had on earnings, okay? And it's not just, it's an easy to say, okay, 3 months, but it's a range of economic factors. The problem with March 31, to be blunt, and that's the easy one, is that we didn't know how long this was going to last. And we thought, and I mean, there was some theory out there that we get into the warm weather time of April, May, or of May, June, July, and August, and this was going to subside. And certainly there was some credence to that, given some of the numbers that at the time were coming out of the state of Florida. The problem is, of course, it didn't. By June 30th, people were saying we had a triggering event, qualitative. They did the qualitative assessment. We went from there. So I think that I would say 3 from a really strong impairment position, Gabe. I agree with you. It's probably 6.
Okay. That's, the remaining questions I get into kind of allocation of things in the quantitative, which we're going to cover when we get to the quantitative section. But one more.
Okay.
We're here, so I'll kick it back to you for quantitative.
Okay. Couple of quick things. First of all, ASC 820 melds with, this is where the valuation and the accounting profession come together, okay? Good valuation practices mean that you have market measures of critical assumptions. And when I work with our clients, when our firm does, the first thing we ask people is, what are your critical assumptions that go into your projections? Your loan cost, your loan yields, your deposit cost, your investment yields. What did you look at? Your cost containment, control premiums, all the things that you are building into your projections. The question has to be, where did it come from? Why is it market participant in nature? Okay? And if you're using market comparables, tell me a little bit, either first as a valuation person and later as an accountant, as to why the comparatives that you're using are in fact comparative to your institution, which leads us to the credit union space. And this is a unique circumstance for credit unions because, and I know we've got a few in the audience today, the big issue with credit unions is that there aren't any public companies to compare yourselves to. There aren't any real mergers and acquisitions that are out there that are publicly available information that you can work with. Most of the deals in the credit union space either are credit unions buying banks or they're credit unions, larger credit unions assuming smaller credit unions. Okay, my argument is really simple, okay? Number one, who are the institutions, the financial institutions that are closest to credit unions? The answer is savings and loan associations. There aren't a whole lot of those left anymore either. But my focus there is to say, okay, they're consumer financial institutions for the most part, like credit unions are. So let's begin with looking at that group. The second issue that I'll say for credit unions is the whole issue of exit multiples. I would focus again on savings and loan associations. But secondly, where do we put the most emphasis when we value them? And the answer's got to be on the discounted cash flow or the income approach. So if you're a credit union, you've got some unique circumstances, I admit, but this is still very much doable. So what you do if you have to get through and you're dealing with a triggering event. Obviously, you begin by dealing with the qualitative assessment issues that Gabe dealt with. Then I look at my financial projections. I double check where my comparable public companies are trading and look at the qualitative factors where your market's competing. Again, if you're in Hawaii or Florida, you got a different situation than if you're in the Silicon Valley of California. You look at the M&A market, and the other question is, how have you weathered the financial storm? Again, I'm going to go back to something we've worked with a lot lately, and that's the question of how many of your clients took PPP, that if they didn't, and they're commercial customers, you got to ask why not. The second issue is the deferrals. And if you're seeing a dramatic decrease in deferrals from the first quarter to the second quarter of this, the positive thing, if you're trading closer to book, you're probably going to be able to do a qualitative assessment. So, with that, Amy, we have the last question.
Yes, so the fourth and last question is, what is your earnings forecast for 2021? A, less than 10% earnings growth. B, 10% or more earnings growth, but less than 20. C, 20% or more earnings growth. Or D, I have a number, but I'm not confident enough to disclose it. Or E, I'm here for the CPE. And once you have completed all CPE requirements, you're able to download a PDF of your certificate from the CPE progress window to the right of the slide view. And we will give a few more seconds for everyone to respond. Okay, here are the results.
All right. So dialed back expectations, I think. I know a lot of the major investment banks didn't have a lot of change to 2021 outlooks early in the year, but just in the last month or two, pretty consistently, from a consensus, at least in the banking side, 25% decrease in earnings from forecasts earlier in the year.
And by the way, Gabe, to your point, one of the things that we do when we're assisting our clients with ASC 350 work is if they're publicly traded and they have a research following, we ask for the research reports, because that's one way to cross-check what we're about to talk about with is the projections, okay? And so if you're into a quantitative, the first line of defense is your financial projections. And again, assuming that you've been very careful and very well put together, the first question you ask is how realistic is what you're doing. We talk about yield curve, we talk about deposit flows, loan originations. If you've got non-interest income, if you've got a bank that, if your bank or your credit union is focused on gains and sales of mortgages and securities, you know what, you're probably having a pretty good year this year. But the question's going to be next year and the year after that, is it reasonable? And two other issues. Does the capital support the growth that you have? If you've got aggressive growth or if you're optimistic about where you're going to go, can your capital support it? This all has to be reflected in how you project what you do. Second one is expense control. And quite frankly, if you've got an expense control program, you better be documenting it to make life easier for yourselves. Okay, one of my favorite things that I see, and I've been doing this for years and years, even before I was doing Goodwill Impairment, was the infamous hockey stick. And we have kind of a version of the hockey stick in this graph on the right, where this bank, what goes from $4 million to $9 million over 5 years of net income. Okay, typical hockey stick. You see it if rates change and the spreads and margins widen. Guess what? Theoretically, it's possible. Hockey sticks may very much be right. But if you're seeing that, and if you're seeing big numbers on the back end of your projections, the two things that I would encourage you to do is sensitize some of the variables and see how that changes. And secondly, look at the critical assumptions that you have in that to ensure that those numbers are reasonably close to being accurate. Nobody's saying, including me, is saying that a hockey stick is wrong. What we're saying is, how did you get here? And that's the big question, is what made that hockey stick? How can an evaluator, in this case, an audit firm that's testing for goodwill impairment, how can they be confident that you're going to accomplish these goals? Okay. If you look at the next slide, in the chart on the right, we did a little bit of playing around with those round numbers. And we simply said, okay, let's take those cash flows and let's assume that we have an 11% discount rate, 3% terminal growth rate. The fair value is $90.6 million in this case, 68.8 million of which came from the terminal value. So if I've got 70% of my value, or 76% of my value in the tail end of this, I can promise you that you're going to get audit questions around what makes you confident this is going to happen, how did you sensitize this, and so forth. Again, nobody's arguing it's wrong. It's just going to require a layer of documentation to how you're going to get to the back end. Okay, are your projection drivers that drive your growth? Can they be demonstrated based on what you've done in the past? Are they market participant in nature, meaning that your loan yields are consistent with some kind of change in market interest rates? So, if you've got problem loans, they're going to have them. Hockey sticks will come in a lot of cases once a client who's had problem loans works out the problem loans, and you don't have the burden of a non-performing asset that you have to carry. Okay. Couple of things. One other thing, and this is something that particularly with my young staff that we drive home, in developing your financial projections, okay, make sure you're careful about what constitutes free cash flow. We see way too often double counts in this when we look at projections, when we talk to clients. The issue is your dividends are not your free cash flow. And one of the situations that we often have to deal with is the concept that, okay, I've got all this net income, but I'm pouring it into retained earnings, which may be what you do for shareholder return purposes. It may not be what you do for purposes of measuring free cash flow. Free cash flow is the cash flow from earnings and any excess capital above and beyond what you need to sustain your institution, to capitalize your growth. And it's available for shareholders. If you wanted to dividend it, you could. You didn't necessarily have to. But in an extreme circumstances, let's say you don't pay dividends as a general rule. That means there's no cash flow. If you're pouring everything back into the institution as capital and you're saying it's necessary, the only value is going to come from the terminal value. Okay. A couple of other points to consider. Guideline transactions. At the end of the day, in addition to picking your peers, you have the fundamental question of what is the control premium? Now, this chart on the right just basically shows the control premiums looking at everything that has a control premium, that has a 3-month control premium greater than 0, okay? And what you're seeing is what we've seen a lot of over the years, and that is that there is a control premium that's pretty substantial for strong institutions in an economically distressed time, okay? So when you're looking at your when you're looking at how you price off your guideline transactions, keep in mind that you need to be careful and you need to manage where the control premium is and what's happening to those and why you should use a particular number. Okay, reconciliation. For most of you out there, particularly, you're going to be looking at 3 measures: the discounted cash flow, publicly traded guideline companies, and guideline transactions, okay? This is one, we've obviously changed the numbers quite a bit, but this is indicative of what we were doing in June with one of our clients. They came up with a value, DCF, of $1.1 million 1.1 million for publicly traded, and almost a little over 1.11 million for Guideline Transactions. First of all, we like that when we see that, because what that means is the valuation for all three methods is close enough to each other that we feel pretty good about it. We weighted at 60% to the discounted cash flow method, and in this case, the reason we did that is because we felt pretty comfortable that their income method was reasonably good and that the numbers were there, okay? You got to look at these. The only thing I would say, if they're changing quarter over quarter in the weightings, you're going to run into some issues. The last thing is market cap reconciliation. This is a quickie. You can see up at top, we had about a $1.1 million concluded value based on the three methods we showed you just now. The stock price of this company was $18 a share at June 30th. They had 39.7 million shares outstanding, $713.8 million of market cap, okay? We've got a control premium of 54%. You look at it against the 1 month average price, it's 46%, okay? This gets a little gamey when we reconcile with multiple reporting units, but this is the first place the auditors look at. And it's a question of what does your value show to the market price and how much of a control premium do you see? And they go back and look at what we showed you 2 slides earlier, and they say, does this make sense? Okay. So in this case, the company was not impaired, okay? 54%, the auditors bought into that in this circumstance. It's not. It's different for just about every institution. So with that, I'll turn it back to Gabe for any questions.
Yeah, we're about out of time. I would say, you and I have discussed this, that the weighting for the cash flows, the DCF, is probably higher than I've ever seen. It used to be kind of the low weight thing in the impairment analyses, but nowadays, because of, I presume it's the reliability of the peer, or the comparability of the peer metrics, and then just with the stock prices on the stock price piece of the allocation, that's getting a really low weighting as well. We're about out of time, but am I saying that correctly?
Yes. Gabe, can I throw one last quick point in? 30 seconds.
Okay.
And that is, if you're building a comp group, one of the things I would encourage everybody to look at is to kind of measure the amount of trading volume in the stock of the guideline company. If there's got to be enough there to make it a worthwhile comparison.
All right. With that, we'll take it back to Amy to wrap up.
All right. Thank you, Dave and Gabe, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all CPE requirements, your certificate is available to download now in the CPE progress window. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us. We hope you'll join us again next time.